So, $53 billion. That's how much U.S. bank stocks lost in a single trading session today, the worst day for American banking stocks in over 3 years. And here's the chain of events that caused it. Donald Trump's tariffs triggered Canada's most aggressive financial retaliation in history. Mark Carney's government blocked U.S. banks from operating in Canada. J.P. Morgan, Goldman Sachs, Bank of America, Morgan Stanley, Citigroup, Wells Fargo, all of them cut off from the 9th largest economy in the world. And the market responded by wiping $53 billion off their combined market value before the closing bell. Warren Buffett, whose Berkshire Hathaway lost an estimated $1.5 billion on its bank stock holdings today alone, issued a statement tonight that I've never heard the equivalent of from him in 50 years of public life. When the world's greatest investor loses $1.5 billion in a single day because of a trade policy and then tells you exactly whose fault it is, you need to hear what he said. If you own bank stocks in your portfolio, in your retirement account, in your 401k, in your index fund, you lost money today. If you hold any financial sector ETF, you lost money today. The KBW Bank Index had its worst session since the regional banking crisis. Credit default swaps widened. The VIX Fear Index spiked 18%. And the after-hours trading says tomorrow might be worse. Subscribe now, because this is the story of how a tariff triggered a retaliation that triggered a $53 billion crash, and why the smartest investor alive says the damage isn't over. Let me walk you through what Canada did, because the trigger itself took less than 30 seconds to read, but took about 7 hours to fully detonate on Wall Street. At 7 a.m. Eastern Time this morning, Canada's Office of the Superintendent of Financial Institutions, OSFI, the regulatory body that oversees all banking activity in Canada, issued an emergency directive suspending the full-service operating licenses of all U.S. headquartered banks with Canadian subsidiaries. Effective immediately, 6 major banks directly named J.P. Morgan Chase, Goldman Sachs, Morgan Stanley, Bank of America, Citigroup, and Wells Fargo. The suspension means no new investment banking deals, no new wealth management clients, no new capital markets activity, no new M&A advisory mandates in Canada. Existing positions are to be wound down over 180 days. After that, the doors close completely. In plain English, Canada just told the 6 most powerful banks on earth that they're no longer welcome to do business in the 9th largest economy in the world. The timing was deliberate. 7 a.m. Eastern gave the news exactly 2.5 hours to propagate through every Bloomberg terminal, every trading desk, every risk management system on Wall Street before the opening bell. By 8 a.m., every portfolio manager with bank stock exposure had called their risk officer. By 8:30, the risk officers had called compliance. By 9 compliance had called legal. And by 9:25, 5 minutes before the market opened, the sell orders were already stacked so deep that the opening was going to be a massacre, and everyone on every trading floor in Lower Manhattan knew it. OSFI cited reciprocal financial sovereignty measures, a direct response to U.S. Treasury restrictions on Canadian financial institutions, and the broader tariff escalation that has defined the past several months of the trade war. Carney's public statement was 3 sentences, measured and devastating in its calm. Canada has always supported open financial markets, but open markets require mutual respect. When that respect is absent, we adjust our exposure accordingly. The word adjust was doing all the work, framing the most aggressive financial retaliation a G7 nation has ever taken against another G7 nation's banking system as a simple, rational recalibration, not anger, not revenge, an adjustment. And the diplomatic restraint made it harder for Washington to respond with escalation because there was nothing inflammatory to react to. Just a policy, just a directive, just the end of Wall Street's access to a trillion-dollar financial market. Now here's the insight that explains why the market crashed $53 billion instead of the $15 billion or so that the Canadian revenue loss alone would justify. U.S. banks earn an estimated $14.8 billion annually from Canadian operations, investment banking fees, wealth management for high-net-worth Canadian clients, asset management for Canadian pension funds that collectively hold over $1.4 trillion in assets. To put that pension fund number in perspective, the Canada Pension Plan Investment Board manages $570 billion alone. The Ontario Teachers Pension Plan manages $250 billion. The Caisse de dépôt in Quebec manages $420 billion. These are among the most sophisticated and most coveted institutional clients in global finance, and U.S. banks have managed significant portions of their portfolios for decades. Add M&A advisory on Canada's $180 to $220 billion annual deal pipeline, capital markets trading on the Toronto Stock Exchange, and commodity trading in energy, minerals, and agriculture, and you get $14.8 billion in annual revenue, a number the size of a Fortune 500 company, gone in a single directive. That's a lot of money, but the loss of $14.8 billion in annual revenue would normally produce a 1 to 1.5% decline in bank stocks. The market didn't drop 1%, it dropped 3 to 4%. it dropped $53 billion because the market didn't just price in the loss of Canadian revenue, it priced in something much bigger, the demonstration that a G7 ally, America's closest neighbor, its largest trading partner, a country that shares the world's longest undefended border, can lock American banks out of its financial system with a single regulatory directive. That's not a Canada problem, that's a structural problem. Because if Canada can do it, the European Union can do it, the United Kingdom can do it, Japan can do it, Australia can do it, and the market, in its cold and efficient way, priced in the probability that at least some of them will. The $53 billion wasn't about Canada, it was about what Canada proved is possible, and once the market understands that a risk exists, it prices that risk into every share, every bond, every derivative, immediately and permanently. Let me walk you through the trading day, because the way $53 billion disappears in 7 hours is something most people have never seen up close. At 7 a.m., when the OSFI directive hit the news wires, bank stock pre-market trading activated within minutes. JP Morgan, which had closed the day before at $222 per share, showed pre-market bids at $215. Goldman Sachs, which had closed at $496, showed bids at $480. Bank of America, which had closed at $29.55, showed bids at $28.80. NASDAQ futures dropped 0.5%. CNBC broke into regular programming with a breaking news banner. Bloomberg's Terminal Alert System, the messaging platform that connects every institutional investor on Earth, lit up with red headlines and urgent commentary. The futures market, the market that trades around the clock and reacts first to overnight developments, had already delivered its verdict before most Americans finished their morning coffee. Trading desk phones started ringing before the sun had fully risen over lower Manhattan. Portfolio managers calling risk officers calling compliance, compliance calling legal calling outside counsel to figure out what OSFI's directive actually meant for their Canadian operations. By 9 a.m., 30 minutes before the opening bell, every trading desk on Wall Street knew what was coming. The sell orders were stacking up in the exchange's pre-open queue, visible to anyone with a Level 2 market data terminal. The ratio of sell orders to buy orders was running 4-to-1 on the major bank stocks. The only question was how bad. At 9:30 a.m., the opening bell rang. The opening cross, the mechanism that matches buy and sell orders when the market opens each day, was massively imbalanced. For every buyer of JP Morgan stock, there were approximately 4 sellers. JP Morgan opened at $213, a $9 gap down from its previous close of $222. That single opening tick wiped approximately $16 billion in market cap. $16 billion gone in the time it takes to print one number on a screen. Goldman opened at $478, down 18 from the previous close. Bank of America opened at $28.40. Wells Fargo, Morgan Stanley, Citigroup, all gapped down between 2 and 4% at the open. The opening bell wasn't a bell today, it was a starting gun for a selling stampede. Between 9:30 and 10:30 a.m., the first wave hit, and it wasn't human. Quantitative trading algorithms, the computer programs that now account for over 60% of daily U.S. stock market volume, activated their sell protocols. These algorithms are programmed with specific triggers: sudden revenue estimate downgrades, geopolitical risk events, regulatory actions against the financial sector. The OSFI directive triggered all of them simultaneously. The algorithms don't panic, they don't hesitate. They don't call their spouse to talk about whether this is the right move. They execute. And when hundreds of algorithms all execute sell orders on the same 6 stocks in the same 10-minute window, the selling pressure overwhelms the available buyers. The bid side of the order book evaporated. Market makers widened their spreads to protect themselves. The price fell, which triggered more algorithmic selling, which pushed the price lower, which triggered more selling. By 10:30 a.m., 1 hour after the open, the combined bank stock loss had already exceeded $30 billion, and the human selling hadn't even fully begun. The first $30 billion wasn't lost by panicking humans. It was lost by machines doing exactly what they were programmed to do. Between 10:30 and noon, the contagion started spreading. The bank stock crash began bleeding into the broader financial sector. Regional banks, PNC, US Bancorp, Truist, M&T Bank, none of them directly affected by the Canada block, but all falling between 1.5% and 2.5% on contagion fears. The market logic was simple and terrifying. If Canada can block JP Morgan, what stops other countries from blocking American banks? Insurance stocks fell on counterparty exposure to the affected banks. The KBW Bank Index, the benchmark that tracks U.S. banking stocks, hit its worst intraday decline in over 3 years. Credit default swaps on U.S. bank debt widened significantly. meaning the cost of insuring against a bank default increased in real time. The VIX, the volatility index that traders call the fear gauge, spiked 18% in a single session. By noon, it wasn't just a bank stock problem. The financial sector was bleeding into every sector with international exposure. Technology companies with Canadian operations fell 0.8%. Energy companies with Canadian partnerships fell 1.2%. Industrials with cross-border supply chains fell almost a full point. The market read Canada's bank block as a signal that the trade war had entered the financial system. And when the trade war enters the financial system, nothing is safe. Between 1 and 3 o'clock, the margin calls arrived. Investors who had bought bank stocks on margin using borrowed money received demands to either deposit additional cash immediately or sell positions to cover their shortfall. A margin call is forced selling. It's not a choice. When your positions lose enough value that your broker requires more collateral, you either wire money or the broker sells your stock for you. And forced selling doesn't negotiate. It doesn't wait for a better price. It hits whatever bid is available. The margin calls push the selling into a feedback loop. Falling prices triggering margin calls, triggering more selling, triggering lower prices, triggering more margin calls. JP Morgan broke below $210, its lowest level in 14 months. The stop-loss orders clustered at $210. Automatic sell orders placed by investors who decided in advance that $210 was their pain threshold fired in sequence, adding more sell volume into a market that was already drowning in it. Goldman Sachs briefly touched the level 1 circuit breaker threshold, the point at which a stock has fallen nearly 10% from the previous close, and the exchange halts trading for 5 minutes to allow the market to stabilize. Goldman recovered just enough to avoid the actual halt, but the near trigger sent a genuine chill through every trading floor on the street. A circuit breaker on Goldman Sachs. That's not a headline traders expect on a Tuesday. In the final 30 minutes, bargain hunters stepped in. Short sellers who had profited from the decline began buying to lock in gains. Value investors who'd been watching the carnage decided that bank stocks at 14-month lows might represent opportunity. The buying provided a modest bounce, enough to bring the losses back from their worst levels, but nowhere near enough to repair the damage. The final tally at the closing bell. JP Morgan Chase, down 4.2%. $24.4 billion in market cap destroyed. Bank of America, down 3.8%, $11.8 billion gone. Wells Fargo, down 3.1%, $6 billion lost. Goldman Sachs, down 3.5%, $5.1 billion erased. Morgan Stanley, down 2.9%, $4.1 billion wiped. Citigroup, down 1.7%, $2 billion vanished. Combined, $53.4 billion in U.S. bank market capitalization destroyed in one trading session. The KBW Bank Index closed down 3.7%, its worst single day since the regional banking crisis of March 2023, and the after-hours trading continued the decline. Futures indicated that tomorrow's open could be lower still. Each of those 6 banks has a different story behind today's carnage. JP Morgan took the hardest hit, $24.4 billion, because it had the most to lose. JP Morgan is the largest U.S. bank presence in Canada, earning approximately $3.9 billion annually from Canadian operations. It was the lead advisor on 3 active Canadian M&A transactions worth over $10 billion each, all 3 now in jeopardy. Jamie Dimon issued a terse 1-paragraph statement calling the Canadian action unprecedented and deeply concerning. But JP Morgan didn't just lose Canadian revenue today. It lost the assumption that its global footprint was invulnerable to Allied retaliation. That assumption, it turns out, was worth more than the revenue. Bank of America lost $11.8 billion. And the reason goes beyond its $2.1 billion Canadian revenue exposure. Bank of America is the Buffett stock. Berkshire Hathaway holds approximately $33 billion in BOFA shares. It's Berkshire's largest individual stock holding by value. When news broke that Buffett's biggest bank position was directly affected by the Canada block, institutional investors didn't just sell on the fundamentals. They sold on the uncertainty. What will Buffett do? Will he add to the position? Will he start selling? The uncertainty about the most followed investor on earth added a risk premium to BOFA that went well beyond the operational loss. Goldman Sachs lost $5.1 billion and briefly touched its circuit breaker threshold, the single most alarming moment of the trading day. Goldman's Canadian exposure is concentrated in the highest margin business in banking, M&A advisory and investment banking. Goldman was advising on the largest pending Canadian deal, a $14 billion energy sector consolidation, representing one of its biggest single advisory fees globally. The Canada block means Goldman can no longer legally advise on that deal. Canadian banks, RBC Capital Markets, TD Securities, BMO Capital Markets, are already circling to replace Goldman as lead advisor, And they're not just circling on that one deal. They're circling on every active mandate that U.S. banks can no longer service. Bay Street is ready to absorb what Wall Street just lost, and the Canadian banks have the scale, the sophistication, and the client relationships to do it. Wall Street's loss is Bay Street's gain, and the transfer is already happening in real time. The remaining three, Wells Fargo down $6 billion, Morgan Stanley down $4.1 billion, Citigroup down $2 billion, each suffered from their own specific vulnerabilities. Wells Fargo's Canadian commercial banking and real estate finance exposure compounded existing domestic regulatory pressure. Morgan Stanley's wealth management relationships with Canada's wealthiest families were legally severed in a single directive. Citigroup's role in cross-border trade finance and payment infrastructure was disrupted in ways that ripple far beyond the headline number. 6 banks, 6 different stories, one common theme. Nobody on Wall Street priced in the possibility that America's closest ally would lock them out of its financial system. Today, they're all repricing. And that brings us to the man who lost $1.5 billion of his shareholders' money before lunch. Warren Buffett released a formal statement tonight. That alone is significant. Buffett almost never comments on single-day market events. He's the most patient investor alive. He doesn't react to daily noise. He spent 60 years telling people to ignore short-term market fluctuations and focus on long-term value. The fact that he issued a formal written statement about today's crash tells you everything about how seriously he takes what happened. Berkshire Hathaway holds approximately $33 billion in Bank of America stock, $3.5 billion in Citigroup, and several billion more in other financial sector positions. Today, Berkshire lost an estimated $1.5 billion on those holdings alone. When Buffett speaks about the $53 billion crash, he's not speaking from the sidelines. He's not offering academic commentary. He's speaking from inside the wreckage. The market isn't wrong, Buffett said. The market is doing what it always does, repricing risk based on new information. The new information is, a G7 ally just demonstrated that U.S. banks have a geopolitical vulnerability that nobody was pricing in. A single regulatory directive from a single allied nation can lock American banks out of a major economy. That risk premium will now be permanently embedded in U.S. bank valuations. He continued, I've been investing in American banks for decades because I believed in 2 things: the strength of the American financial system and the reliability of the American regulatory environment. Today, both of those beliefs took a $53 billion hit. That's Buffett telling you the market isn't overreacting. The market is correct. The $53 billion isn't panic. It's rational repricing of a risk that nobody had accounted for until this morning. Then Buffett drew the causal chain explicitly and pointed the blame directly at the tariff policy. Berkshire lost approximately $1.5 billion today on our bank holdings alone. I want our shareholders to understand something clearly: that loss was not caused by a banking crisis. It was not caused by bad lending. It was not caused by excessive risk-taking by the banks themselves. It was caused by a trade policy. Our banks are being punished by the market because the government provoked a G7 ally into retaliating against our financial system. That's not market risk. That's policy risk. And policy risk is the one kind of risk I cannot hedge. Then the line that will echo through every trading floor tomorrow morning. There's an old saying in investing: when the tide goes out, you see who's swimming naked. Today's $53 billion proves that American bank stocks were priced as if the tide would never go out, while Canada just pulled the plug on the ocean. On the question of what comes next, Buffett was direct. The question everyone on Wall Street is asking tonight is whether this is the bottom, and the answer is, it depends on what Washington does next. If the tariff policy is reversed, markets will stabilize. If the tariff policy escalates, the next country to block American banks might not be Canada. It might be the EU or the UK or Japan. And if that happens, the $53 billion we lost today will look like a warm-up. He confirmed he is not selling his Bank of America position, but added a qualifier that rattled institutional investors. The thesis that justified our position that American banks were the safest, most reliable financial institutions on earth took damage today that cannot be repaired by one good earnings report. This is structural. A Berkshire board member described the mood. Warren was calm. He's always calm, but there was a sharpness to it. He said, we just lost $1.5 billion because a tariff triggered a retaliation that nobody in Washington thought through. I'd like someone in the White House to explain to my shareholders why that was a good trade. And then he paused and added, I suspect I'll be waiting a long time for that explanation. When the Oracle of Omaha tells his shareholders that the American banking thesis took structural damage, the foundational investment thesis that has underwritten the global financial system for 80 years, that statement echoes through every pension fund, every sovereign wealth fund, every family office on the planet. It's not a tweet. It's not an opinion. It's a $130 billion investor telling the world, I'm worried. And when Buffett is worried, everyone else should be terrified. Now let me tell you what the $53 billion means beyond bank stocks, because the contagion from today's crash is already spreading. The S&P 500 closed down 1.4%, losing approximately $560 billion in total market value. The financial sector's weight in the index dragged everything lower, but the contagion went beyond mechanics. Every sector with significant international exposure fell. Technology companies with Canadian operations dropped almost a full percent. Energy companies with Canadian partnerships fell 1.2%. Industrials with cross-border supply chains declined 0.9%. The market read Canada's bank bloc as a signal that the trade war has entered the financial system, and when the trade war enters the financial system, the repricing doesn't stop at bank stocks. European bank stocks fell 0.5% to a full percent in sympathy trading. Asian markets, which were open during the U.S. afternoon session, showed losses as the news rippled across the Pacific. The $53 billion on Wall Street triggered an estimated $80 to $100 billion on additional global market losses before most of the world had gone to sleep. For the average American, the damage is personal and immediate. The S&P 500's 1.4% decline translates directly into retirement accounts. The average American 401k balance is approximately $112,000. A 1.4% decline means the average American worker lost roughly $1,500 in retirement savings today. Not because of a recession, not because of a pandemic, not because of a financial crisis caused by reckless banking or speculative excess. Because a tariff triggered a retaliation that crashed bank stocks and dragged the entire market down with them. Every American with a 401k paid for today's trade policy, whether they voted for it or not. For Americans closer to retirement, those with balances of $300,000, $1 million or more, the losses are proportionally larger and the time to recover is proportionally shorter. A 60-year-old with a $500,000 retirement account lost approximately $7,000 today, and they have maybe 5 to 7 years before they need that money. Financial advisors across the country spent the afternoon fielding panicked calls from clients asking whether they should sell everything and move to cash. The most dangerous moment in a market crash isn't the crash itself. It's the phone call from a retiree who's watched their savings drop and is ready to lock in the loss by selling at the bottom. Because if enough people make that call, if enough retail investors panic sell at the worst possible moment, the crash feeds on itself and gets worse. In the credit markets, the institutional markets that most retail investors never see, but that professionals consider far more important than stock prices, the signals are even more concerning. Credit default swaps on major U.S. bank debt widened significantly, meaning the cost of insuring against a bank default increased in real time as the trading day progressed. Bank bond yields rose as prices fell, investors demanding higher returns for the increased risk of holding bank debt in a world where allied nations can restrict bank operations by regulatory fiat. The interbank lending rate ticked upward, a subtle but ominous signal that banks are slightly more cautious about lending to each other. That kind of micro-hesitation in interbank lending is the same tremor that preceded larger credit events in 2008 and 2023. Moody's and S&P both issued statements noting they are monitoring developments related to the Canada bank bloc. In rating agency language, monitoring is the word that comes before reviewing, which is the word that comes before downgrading. A credit downgrade for any of the big six banks would be catastrophic. It would increase their borrowing costs by billions, reduce the collateral value of their bonds, and trigger contractual provisions in thousands of derivative agreements that reference the bank's credit rating. The rating agencies haven't acted yet, but they're watching. And when rating agencies watch, banks lose sleep. Trump's response arrived at 4:47 p.m., 47 minutes after the closing bell. Canada will pay a heavy price for this attack on American banks. We will respond with overwhelming force. The problem with threatening overwhelming force when the market is already down $53 billion is that escalation promises don't calm markets. They terrify them. Investors who were hoping for a conciliatory signal, some indication that Washington would de-escalate, reverse the tariffs, or negotiate with Ottawa, instead got a promise of more confrontation. After Trump's post, S&P 500 futures dropped an additional 0.3%. The after-hours trading that had shown tentative signs of stabilization immediately resumed its downward trajectory. Republican senators on the Banking Committee requested an emergency briefing from the Treasury Secretary. Wall Street bank CEOs, the same executives who had previously supported Trump's trade agenda, who had donated to his campaign, who had attended his events and praised his deregulatory approach, requested an emergency meeting at the White House demanding an off-ramp. The political dimension is straightforward. The people who lost $53 billion today are some of the largest political donors in the country. Bank executives and major bank shareholders aren't populist voters who can be placated with rally rhetoric and strongman posturing. They're people who write checks to campaigns, to PACs, to super PACs, to both parties. And right now they're writing letters to Congress, to the White House, to anyone who will listen, demanding that the tariff policy be reversed before the next trading session opens. 3 questions hang over tonight's markets. Asian markets open in hours. Will the sell-off continue across the Pacific? European markets open tomorrow morning. Will London, Frankfurt, and Paris extend the damage? And the policy question that towers over all others: will Trump escalate, hold steady, or reverse? 3 questions, 0 answers. And markets hate nothing more than unanswered questions. So here's what happened today. Trump's tariff policy provoked Canada into blocking U.S. bank operations. J.P. Morgan, Goldman Sachs, Bank of America, Morgan Stanley, Citigroup, and Wells Fargo all cut off from the 9th largest economy in the world. The market responded with the worst single session for U.S. bank stocks in over 3 years. J.P. Morgan lost $24.4 billion in market cap. Bank of America lost $11.8 billion. Goldman Sachs lost $5.1 billion and briefly approached its circuit breaker threshold. Wells Fargo, Morgan Stanley, and Citigroup combined for another $12.1 billion. Total $53.4 billion in U.S. bank market capitalization destroyed in a single trading session. The broader S&P 500 lost 1.4%, roughly $560 billion in total market value. The average American 401k lost approximately $1,500 to credit default swaps widened. The VIX spiked 18%. Rating agencies are watching. The interbank lending rate ticked upward. Warren Buffett, whose Berkshire Hathaway lost an estimated $1.5 billion on its bank holdings today, called the tariff policy risk that I cannot hedge, and said the American banking thesis took structural damage that cannot be repaired by one good earnings report. Trump promised overwhelming force in response. S&P futures dropped further after his statement. Bank CEOs are demanding a White House meeting. Asian markets open in hours. The $53 billion is the number. But the question is what the number means. If this was a one-day overreaction, markets will recover. Bank stocks will bounce. The $53 billion will be a bad memory and a cautionary anecdote. But if this was rational repricing, if the market correctly identified a permanent new risk in American bank valuations, a risk that didn't exist yesterday and exists today and will exist every day from now on, then today is the beginning, not the end. And when Warren Buffett, the most patient investor in the history of finance, calls it structural damage, the rational repricing explanation starts to look a lot more likely than the overreaction one. The $53 billion traces back to a tariff. The tariff was supposed to make America stronger. Instead, it triggered a retaliation that proved American banks are geopolitically vulnerable, crashed their stock prices, wiped out retirement savings, spooked credit markets, and prompted the world's greatest investor to issue a formal warning to his shareholders. Watch the Asian Open tonight. Watch the European Open tomorrow morning. Watch the S&P futures through the overnight session. Watch the credit default swaps because the institutional money watches the credit markets more closely than the stock market, and the credit markets are sending signals that should keep bank executives up all night. Watch Trump's next move and the market's reaction to it, because if the next statement is escalation, the selling resumes. And if the next statement is conciliation, the market might stabilize, and Washington's choice between those two options will determine whether today was a bad day or the first day of something much worse. Because the $53 billion was today, tomorrow is a new trading session. And the question the market will answer tomorrow is the same question it answered today. Is it safe to own American bank stocks in a world where America's trade policy can trigger your largest ally to lock you out of their financial system? $53 billion. One trading session, one tariff policy, one allied nation that said enough. The tariff was supposed to be the weapon. Today, it was the wound.